What's up guys, Jules here. Alright, this is going to be a pretty hefty video and I'm not going to be able to cover 100% of it, but this is going to be a good starting guide to at least understand how options work and how to get started and kind of like the risks involved and stuff like that. So let's get started. What I want you to take a look at is the key takeaway. Options are financial derivatives that gives buyers the right but not the obligation to buy or sell an underlying asset at an agreed upon price and date. So what is going on here? What is this saying? When you buy a call option, an options contract, you can do one of two things with that option. What you're doing is you're buying the right to exercise that contract and buy 100 shares of that stock. So if you were to do it with Square, which is at about $230 right now, and you bought a call option and you exercised it, now you would have to purchase 100 shares of Square at an agreed upon price. Well, a lot of you guys probably don't have $23,000 lying around, so you're probably not going to exercise your contract. The second thing you can do with a contract, you can sell the contract. So as the contract gains value, you can sell it. So you do not have to buy the 100 shares. You can buy the contract and then you can sell the contract and get rid of it. You can make money from selling that contract. One of the key differences between stocks and options contracts is that there is something called time decay, and this is very important. Time decay is a measure of the rate of decline in the value of the options contract. Due to the passage of time, time decay accelerates as an option's time to expiration draws closer, since there's less time to realize a profit from the trade. It is also known as Theta, which is one of the option Greeks. We're going to talk about the Greeks moving forward, but I just want to show you this graph, right? So if you buy a contract and the expiration date is 9 months from now, you'll notice that you keep 100% of the value for a little while, right? And then it starts going down in value. Let's assume the stock does not move. Let's say you buy an options contract at 70, the share price is $70 and that doesn't change at all. It just, which is impossible. It's always going to fluctuate, right? But for the sake of argument, it never changes. That means 9 months, you have 100% of the value. Maybe a couple months in, 2-3 months in, well, now you're probably at about 90% of the value, because the stock didn't go up. It didn't go down, but it also didn't go up. And just because of the passage of time, you already lost 20% of the money that you paid for this contract for. If you hold it longer, guess what? It ramps up and accelerates. So as it gets closer, maybe like to the last month or the last 2 months, now you just lost 50% of your money. And then if you wait even closer till the end, you can lose up to 80 or 90% of the money that you paid for that contract. A stock, you can hold forever. You can hold for 100 years, 200 years. You don't lose anything. You don't get punished. The only thing you lose is the fluctuation, and you only really lose when you sell. So the difference between a stock and an options contract is that there's an expiration date, and based on the amount of time that passes, you lose money and you lose value of that contract. So now you're probably wondering, Jules, why in the world, if there's a time decay, why wouldn't I always just get the stock then? It's just safer, it makes sense, right? I'll explain. Over here we have an example of leverage. One of the biggest benefits of using an option is leverage. What I mean by that is, let's say an investor has $900 to use on a particular trade. So you have $900, right? And you think that the company XYZ is going to go up in value. You would buy a call option if you think it's going to go up and you would buy a put option if you think the price is going to go down for the company. So calls and puts are the two different ways to play options. One is you're betting that it's going up, put is you're betting that it's going down. That's neither here nor there, I just wanted to clarify the language. Now let's assume that the share price is $90 on company XYZ. So the stock is at 90, and that means that if you have $900, you can buy 10 shares, right? Because 90 times 10 is 900, and that's all the money you have. You can buy the 10 shares, right? Or you can buy a 3-month call with a strike price of $95, and we're gonna get to that, don't get overwhelmed. That costs $3. And since an options contract gives you the right to buy 100 shares, we have to multiply that $3 by 100. So it's not going to be $3, it's actually going to be $300 as the cost for one contract. Don't worry, I know it doesn't make any sense right now, but it will. So instead of buying the shares, the investor buys 3 call option contracts. Buying 3 options option calls will cost $900, right? Because 3 contracts times 100 shares times $3 is $900. You have the 2 parallels. You can buy 10 shares for $900 or 3 contracts for $900, right? These are the 2 camps that we're in. Shortly before the call option expires, which we just talked about expiration dates and time decay, suppose XYZ is trading at $103 and the calls are trading at $8. So remember what I said about multiplying by 100, right? So at which point the investor sells the calls. Here's how the return on investment stacks up in each case. Outright, the purchase of XYZ shares at $90. So if it goes from $90 to $103, you just made 13 bucks on your shares, right? From 90 to 103 is 13. And since you had 10 shares, you multiply 10 by 13, and that's your profit, $130. Pretty cool, right? So you just made $130 on a $900 investment. The contract, however, the premium went up to $8 times 100. It's for the right of 100 shares, so that's 800 times 3 contracts. So 800 times 3 is 2,400. And obviously you have to subtract what you paid for the options contract. So you subtract the 900 from the 2,400, and you just made $1,500 for an investment of $900. So this is why people use options. You're leveraging the same $900, but you're getting like 10 times the value, right? Because in this example, we made 130 bucks, but we were safe and we don't have time decay and we don't have to worry and we could hold it as long as we want. And if it doesn't go right, we could just keep holding it and wait till next year or the year after. Maybe eventually it'll go up and then finally make our profit, 130 bucks. Sweet. Or we can, be more risky, put the 900 in. We're on a timer now, so it's every, day that passes by, you're losing money. And if the stock doesn't go in the direction that you want, you're losing money. And if it doesn't, if it stays the same or it goes down, you're losing money. Because time decay, if it stays the same, and if it goes down, time decay plus it's going in the opposite direction that you predicted. So the only good scenario is that it goes up and it goes up early, not late at the end of the expiration, right? Does that make sense? So of course, the risk with buying the calls rather than buying the shares is that if XYZ had not traded above 95 by option expiration, the calls would have expired worthless. You would have lost all 900 of your dollars. In fact, XYZ had to trade at $98, $95 strike plus 3, or 9% higher than its price where the calls were, just to break even. If you bought the contract at $90 even if it went up to $98, that doesn't necessarily mean you're going to make any profit, because time decay plus the stock going up, if it doesn't go up enough or soon enough or at a high enough rate, you could lose money. So there is a lot of inherent risk involved with options contracts. So I know you guys are probably tired of seeing this page. I'm just going to click on trade Square options just to show you how I would probably execute a trade. So what we're looking at right now is the spread, right? So I know a lot of this stuff probably doesn't make much sense, but hopefully it will at the end of the video, because there's something else I want to show you guys. But options contracts have a couple of components. They have an expiration date, which we talked about initially. You choose that expiration date. So if we click here, you can see I can choose April 9th, I can choose April 16th, April 23rd, April 30th. Hell, I can even go down to January 2023. Let me just show you guys the difference. So let's just choose April 16th for the sake of argument, right? And let's go with 232, right? Just remember this number right here. This is called a strike price. So these numbers on the left, they're called strike prices. And we're going to go into more detail, but just keep this in mind. At 232.5 call, I'm going to buy. So I'm going to click this plus, continue. Okay, so I just clicked on the 773 and I'm going to input one contract, right? So look at how much it's charging me, $775, right? Because remember, it's times 100 for the 100 shares. So the numbers that you're seeing on the right, that's how much you're going to pay times 100. So it's not $6.80, it's 680. It's not 773, it's $773 for the one contract, right? Hopefully this is starting to make some sense. So now what I'm going to do is I'm going to change the expiration date. I'm gonna go, and we're gonna go really far over here to next year, September, right? So, okay, so 230, right? I'm gonna click the plus, I'm gonna hit continue, and now I'm gonna hit 1. Holy cow, it's charging me $5,100. So what was the only thing that changed aside from the strike price a little bit? The thing that changed was I added more time. I added a longer expiration date so that the time decay doesn't affect me as harshly. Does that make sense? But when you add a longer time, you have to pay more for the options contract. So instead of paying $775, now I'm paying $5,000 because I want a longer period of time for the stock to do what I want it to do, but I have to pay extra for it. So it's safer, but you have to risk more. So that's how they get you, right? So and if I do 2023 and we look at 230, right? So now it's 5,710, right? Which is more expensive than it just was a moment ago, right? 5,700 instead of 5,100, right? So with an extra $600, you're getting another 3 months added to your expiration date. Things to take away so far: the longer the expiration date that you choose, you will have more time and you will be safer, but the contract will be more expensive. Now let's talk about strike prices, right? So right now, Square is at 230.29, right? So let's just assume I think Square is gonna go up. I just think Square is gonna go up within the next 2 weeks. Don't look at anything else right now. Don't worry about anything else. Just take a look at these strike prices. So if you notice, 240 would cost me $250, right? If I'm taking a strike price of 240, But if I take a strike price of 232, it's going to cost me almost double, right? 480. Why would this be true? Why would this be true? We're not changing the expiration date. We're only changing the strike price. Because it is less likely to move up so much, right? They're betting that, you know, it's not going to hit 240. Like, it's so unlikely to hit 240 that we're going to make it cheaper for you to buy this because we want your money, basically. Not in actuality, but basically, right? Like, the odds that it goes to 250 are so low within this expiration date that you only have to pay $85 for this contract. But if it's already at 230 right now, the odds of it going to 232 are pretty high, right? Like, that's not far off. It's not unrealistic for it to hit 232 from 230. That's only a $2 difference. We're going to charge you more for that contract because it's more likely to happen. So you have to risk more, basically. Does that make sense? So the strike price is where you think the share price is going to be headed in. And this influences how much you pay for a contract. We know what an expiration date is. We know what a strike price is. We know what a call and a put is. Basically, the notation for an option is written as the ticker symbol, which is square. So SQ240C, option with a 240 strike price, and it's a call option, 240C. 240P would be a put, right? And then usually number of contracts are written and the premium that you paid for it, which in this case would be 2.42. Generally, people don't write the number times 100 because it's implied. If I buy an expiration out for 1 week and the price jumps on the 7th day, it goes up, my contract's already worthless. It's already expiring, worthless because of time decay. I don't hold any options contract longer than the halfway point of expiration. So if I personally buy a 2-week long contract, I'm selling it after 1 week. If I buy a 1 month long contract expiration date, I'm selling it after 2 weeks. I'm not holding it longer. It's not worth it to hold it longer unless you're already in extreme profit. If I think a stock is going to go up within the week, I buy an expiration date that is 2 weeks out. So it gives me more leeway and more time for my movement to happen. And of course, I set a stop loss. So if I lose a certain amount, I just sell and exit the trade. And I will be doing a live trading session here on this channel. I will probably upload it once I, get everything set up and do some live trades for you guys. Last thing I want to show you guys is this website, optionsprofitcalculator.com. This website is very, very good. I'm going to put it in the description as well so you guys have access to it, as well as some of the other articles that I was linking to talking about options. TSLA, which is Tesla, get price. All right. So Tesla is trading right now at $661. Today is April the 4th when I'm recording this, just for reference. So this site is good because you can practice here and experiment and see profit or losses you would be taking. And I recommend messing around with this website first before you enter any actual options contract trades. And if you're ever going to do that, start very small. Do not risk a lot of money. Do not risk a large percentage of your portfolio. Do not risk anything that you cannot afford to lose, please. So let's do April 23rd, right? This is our expiration date that we're choosing, April 23rd, right? Now we're going to choose the strike price, right? So Tesla's at 661. Let's just pretend that I have insider knowledge and I know that Tesla's going to $700 next week. So what I'm going to do is I'm going to take a 665 call, right? If you notice, it's cheaper, right? If I take the 662 call, $3,900, but if I take the 665 call, it's 3,780. So I'm saving what, like 120 bucks? Probably like a little bit more than that, but whatever. I'll take the 665 call, right? So we're gonna click the middle, and one contract is fine because $3,000 is already a lot of money, right? So now I will hit calculate. Oh, gotta agree. Cool. So let's take a look at this. What are we looking at here? This is, the date is on top, and the share price, the stock's price, is on the left hand side. So let's just assume I was correct, right? And the stock hits $700 on the 5th. Well, cool, I just made $2,000 profit. Isn't that insane? That's kind of crazy, right? But let's say my insider knowledge ended up being delayed, and it took a week longer than I expected for this jump to happen. Okay, 1, 2, 3, 4, 5, 6, 7. So instead of making $2,000, I made $1,500. Not bad, right? Now let's just say it delayed a whole nother week. 1, 2, 3, 4, 5, 6, 7. Now I made $500, which again is pretty good. I invested $3,000. I had some time to, you know, pray to the stock gods, and I made 500 bucks. Not bad. But what if my insider information was a lie? What if it was a red herring? It didn't go quite to 700, but it did go up to 680. And let's say it did that by the 5th. If it did that by April 5th, I made $1,000. But what if it was a week late? 1, 2, 3, 4, 5, 6, 7. I only made 200 bucks and I risked 3,000. What if the same scenario that happened earlier, that I was 2 weeks late? 1, 2, 3, 4, 5, 6, 7. So it still went up to 680, but it happened late. And now I lost almost $1,000 completely, $950, right? Yeah, so as you can see, guys, the point I'm trying to make, the earlier that your bet happens, even if it's just 2 days go by and nothing happens, you lose $62. Another day goes by, you lose $174. Another day goes by. Do you get the point? And if it, God forbid, it goes down, right? God forbid, on the first day it goes down a little bit. Well, now you're in the negative 356. And what if it stays here? Oh no, now you're day by day. And if it goes down lower and another day goes by, right? So you can kind of see how this could end pretty poorly if you don't know what you're doing, right? There is a lot of room for error. The stock could plummet, and if you wait till the end, you're losing potentially all your money, or a good portion of it. That's why you should never wait till expiration day. I will never sell on expiration day. I always sell in this area, the halfway point, or earlier if possible, right? The halfway point is kind of like the point of no return. Once you're in this area, most of it is going to lose money. Even if it goes up to 690, you're losing money on the latter half of the expiration date. Does that make sense? If it goes up to 696 and you're in the latter half of the expiration date, you're still losing money. It's like they're counteracting each other. I want to show you guys just a more realistic example. So let's look at Apple, AAPL. We're going to select the option and we're going to do April 16th, right? So it's a little bit cheaper. And let's just say I think Apple's going to 125, right? So what I would do is I would take a 123 call, strike price call, right? We're going to take this one. So we're paying $234. That's not bad. That is not bad at all. And you can find cheaper options too. If you find stocks that are smaller, cheaper in share price, and lower volatility, you can find $50 contracts. Your returns are not going to be as big, but obviously you have to start somewhere. So we're paying $234 for this, and we think it's going to 125. Market opens on Monday, tomorrow, and it shoots up to 125. I made 50% on my money, right? 128, and we paid 234 for it. About 50% on your money, right? Now, if it doesn't do that the first day, well, maybe it'll do it in a couple of days. Okay, cool. We made $60 on a $230 investment. I would probably sell that contract right there. And if it starts going down, I would probably sell like right here as soon as it goes down a little bit. It's not worth the risk, right? So I invested 234. As soon as I lose 50 bucks, I'm out. I'm not holding it. So you guys see where the potential lies. You see, you know, the risk involved. There's huge risk involved, and I'm going to make a part 2 to this video. If you enjoyed this one, please give it a thumbs up. I hope you guys took notes. I hope you guys wrote things down. Exercising your contract is situational. I will just say that. It depends on how much money you have and the situation that you're in. Consider joining our Discord group and subscribing to the channel for more content like this. We have a Discord group where I announce some of my options plays, and some people have been profitable, making some money following my picks. Thank you guys so much for watching. I will see you all next time.